Welcome back to the podcast, Long-Term Investing with Baskin Wealth. I'm Barry Schwartz, joined by Ernest Wong. Thank you very much for joining us. If you like anything we have to say, please feel free to reach out to us at baskinwealth.com. Check out our website or contact us. We manage portfolios for clients across Canada and would love to talk to you about your portfolio. Ernest, how are you doing today?
I'm good.
What's new? Did you watch the Mike Tyson, Jake Paul fight on Netflix?
I didn't watch it, but I did hear about the streaming issues that Netflix had. And my first reaction was, this isn't good.
Yeah.
Because Netflix's strategy for the next leg of their growth is focused on live entertainment.
Yeah.
They did the fight on Friday night, and then they have NFL Christmas games, and then they have WWE next year.
That's right. And WWE is going to be streaming live on Monday nights, and they can't screw that up, right?
Right.
Okay. So it's a good news, bad news story. The good news, the reason why the streaming, there was so much buffering during the fight was because over 100 million people tuned in to watch the fight.
Right, and the way, and this is quite different from how Netflix normally operates, because the way that Netflix works is that they have hard drives full of all their shows.
Okay.
They put them into a big server room together with the internet service provider.
Yeah.
So then if I'm clicking and I want to watch Stranger Things, it'll go to my local, the nearest server.
All run on AWS, of course.
Yes.
Mostly, we believe. Yeah.
But live entertainment doesn't work that way.
Yeah.
It's a totally different architecture and how you distribute the content. So it's just something that Netflix has to figure out.
There's got to be production trucks and cameras have to work. People were complaining that some of the microphones were no good. Also, some people were complaining about just how the overall presentation of the show was kind of lousy, a lot of dead space. Maybe that has to do with boxing. I didn't watch it. I went to bed. I was very tired that Friday night. I woke up. My wife stayed up to watch it, and I asked her in the morning, should I watch it? And she's like, no good. So
is she a boxing fan?
Not necessarily, but she was playing online. On Friday night, she plays online poker with friends just to chit chat, something that they started during the pandemic. So she usually puts on, a baseball game, a basketball game while playing poker, and everybody was paying attention to the fight.
Right.
Yeah. So you didn't miss anything, but it is very interesting. Obviously, this goes to show you that Netflix has now conquered TV, conquered movies, so to speak. Next is live events. You have to assume they'll work these kinks out, and they've won the war, right? If they can get 100+ million people to watch a baloney prize fight, how many people can they get to watch football, to watch wrestling, to watch possibly Ultimate Fighting, news? And if you and I create a show, we're going to want it to be seen by the biggest audience possible, and that's got to be Netflix, right? Give or take.
So what's interesting about Netflix's experiments with live so far is they've mostly shied away from like the large sports contracts that Amazon or traditional linear TV might focus on. Like they haven't done any large NBA deals, for example.
Yeah.
They don't have like Monday Night Baseball like Amazon.
Yeah.
They're focusing mostly on these big name single events, right?
Yeah.
Where they draw a lot of viewers. Hopefully some people are subscribing just so that they can watch this fight.
Oh, for sure. Right? Because some of these fights on pay-per-view costs 50, 60,
Right.
$80. And here you can just sign up for Netflix, maybe even the ad version for whatever, $10.
Yep.
And you get to watch the fight and keep on Netflix for a month.
Yep.
Yeah, so it's pretty good deal.
Yeah, so I think the reason the stock is up since the fight is that, number one, it highlights how much demand there is for these things on Netflix. And just furthermore, like what's the opportunity for Netflix to grow by doing these kind of things?
The stock was initially down Monday morning about 2%, and now it's recovered that loss and up 5%. And you saw a lot of snarky things
Yes.
on Twitter the next day or that night. Oh, this is terrible for Netflix. This is the stock's going to crash on Monday. Don't listen to people on FinTwit. They don't know what they're talking about. Just us. So, getting back to some serious stuff, Ernest, we've been getting some calls and emails from clients about, okay, Donald Trump has won the election. What does it mean for our portfolio? A lot of people are concerned about the implementation of possibly some tariffs and what that would look like, how that would affect the U.S. economy. Some people are reading the appointments to the possibility of the cabinets and concerned that they may be poor choices. This is not a political show. I don't think we're going to get into whether Howard Lutnick or Scott Bessent are the right picks for the Treasury Secretary. We don't know. But obviously we take those calls with clients. The background is, of course, it's been a good year in the market for 2024. It's been a great year for a lot of asset classes. Stocks are up, bonds are up, Bitcoin is up. It's hard to find a losing thing in your portfolio. And that's on the back of a strong 2023. Your mind may naturally go to, well, I've had 2 good years in a row. Trump could be a wild card. Should I just cash in my chips and call it a day? And, this is something we've talked about before multiple times on the podcast. Ernest, what do you say to clients who are concerned about presidential changes that could really impact their portfolios?
Again, we talked about this last week already,
Yeah.
but I think it's really important to distinguish between your personal views about politics, and about how the country should be operated, and the philosophy, like the kinds of laws that are likely to pass in place, and confuse that with how your portfolio and stocks are likely to do, because those are really 2 different things, as we've seen in the first presidential election, the first time that Trump was president in 2016, is that
there were some similar worries.
Yes, there were similar worries. In that case, it ended up working all right for people who own stocks. Obviously, there are, I personally have some concerns about some of the appointments that he has nominated.
Yeah.
And in terms of how they may impact the names that we own.
Yeah.
But I also don't think that it is wise at this stage to say, oh, you should just sell everything and go into cash. I just don't see how those things are connected.
Yeah. So here's what we're actually doing for our clients' portfolios. We're not making any changes based upon Trump becoming president. So that's not what we would do. We're definitely always looking at client portfolios to see if they're within their target range of asset allocation. And if by luck or by good fortune, their equities are at the high end, we'll look to rebalance based upon their needs and taxation. Those are the things that we're doing. There's going to be winners and losers in every single economy under every single president, and we just don't know how that's going to play out for our clients. But what we'll do is, as always, stick to our process, own a diversified portfolio of great companies, and try not to bet the farm on any one sector or company.
One topic that I think is that Trump has been, a lot of his proposals to me seem somewhat inflationary.
Yeah.
Like particularly things around tariffs and those kinds of things. And I think that the Bank of Canada has, I think, openly noted that it will diverge on a path with the United States, the Fed, with regards to interest rates. We'll see whether that ends up being true, but I think one of the things is that a lot of people often say is, well, Canadian stocks are cheaper today versus U.S. stocks.
Yeah.
But it seems to me that if the outlook for interest rates happens as people think it will, the Canadian dollar is probably not going to be performing too well in the near future.
It doesn't seem like a great outlook for the Canadian dollar at the moment, right? So you have money tends to flow to the country that has the best economic growth, the higher interest rates, stable political government, right? It's certain now that Trump is president. There's some uncertainty what's in Canada right now as to what the next election is going to look like. and commodity prices have come off. Not great for Canada. And the biggest wild card is the potential of tariffs. So in 2016, Trump became president. He did apply tariffs on a number of select goods that did impact Canada, but to a much lesser degree. The talk of tariffs today could be very damaging to the Canadian economy as well as trade. That is not a great outlook for the Canadian dollar. On the other hand, there's so many hands here. The Canadian dollar has already fallen this year, right? So how much of this potential worries is priced in? We just don't know, right? So
yeah, regarding things like the tariffs, I think that in the end of the day, a lot of it is going to come down to economics, right? Because it's easy to come out as a campaign promise to say, I'm going to put a 10% tariff on everything, right? But at the end of the day, I think it's fair to say that Trump is a populist. Like, people care about things like gas pricing and
the price of their iPhones,
right? And so in a large, there's a lot of regions in the US, right, where they do rely on Canadian oil and gas because of just how geography works. So to put a tariff and impact gas pricing in those places
makes no sense.
It doesn't really make a lot of sense to me.
So a number of people are trying to put, a number of economists are trying to put people at ease with saying that, well, if tariffs are implemented, it is a one-time inflationary bump. But it's not like you just keep on increasing those tariffs, we hope. But that would kind of take the concerns away from inflation. It's impossible to know. And there's going to be other wild cards that happen out of the blue. And there'll be trade-offs. So I think we're well positioned for our clients. We don't own a lot of companies that make things, that import things. We're more the knowledge economy type in our portfolios. And I think, most importantly, all presidents want strong economies and good stock markets. That's how they're judged. And so, if anything is really going to impact the stock market, I don't think any president would really love to see the stock market go down hard in under their candidacy. So let's move on from that topic. Ernest, unfortunately, we'll be talking a lot more about Trump and concerns over the next few years, as that's just going to be how it is, and that's how it was in 2016 to 2020. So whether or not those things are going to be material to your portfolio, we'll find out and see. So today we're going to have a special feature at the end of the show. We're going to take your questions from Twitter, and hopefully we'll expand that feature going forward, and to do this once a month. Take your questions on specific stocks, the economy, our process, try and make it a little fun, and we'll give you a shout out for those who ask questions. We'll read out your Twitter name or your regular name, if we can pronounce it, and if it doesn't involve any swear words or bad things. So the list of things we want to talk about today, Ernest, Berkshire Hathaway and some of its buys and sells, Live Nation with stunning results. We already talked about Netflix, and we'll see where the mailbag takes us. I think that's what you should expect today. So let's get into Berkshire Hathaway and some buys and sells, and one that affected our portfolio.
Yeah, Berkshire filed their 13F, which is the report that they filed to the regulators that talks about what stocks they've been buying or selling.
Yeah, so once a quarter, companies who manage over $100 million must release all the trades that they made on U.S. securities in their portfolios. This is a regulatory requirement from the SEC. And so it comes out, so the third quarter of 2024 ended in September. By November, you have to report the trades that you made a few months ago. Is it really relevant?
Well, I think a lot of people like looking at these things because it's like, oh, Buffett bought this stock, so maybe I should copy him.
It's kind of like me and you saying, here's what I had for lunch a few months ago, and if you want to copy that, what I had for lunch, maybe it was good, maybe it was bad, but I may not be having it ever for lunch again. So it's more noise than signal value, but
people like paying attention to these things.
For sure.
It's fun.
It's fun, yeah.
And it was discovered that Berkshire had taken a stake in Domino's Pizza.
Yeah.
We obviously own Domino's Pizza stock. We love the company, but it's a fairly small position for Berkshire overall. I think it's like 0.3% of their equity portfolio.
Although they did buy a meaningful stake
Yes.
of Domino's.
Yes.
So, yeah, go ahead. So why don't you explain, first of all, how much they bought of Domino's and why,
Yeah, they bought 1.3 million shares, so worth about $550 million.
Yeah. Okay, so $500 million worth of Domino's.
I think it's about 3% of all Domino's outstanding shares.
Yeah.
So it's a fairly meaningful amount of ownership
Yeah.
of Domino's Pizza, but it's a very small percentage of Berkshire's overall portfolio.
That's right. And it probably took them a few days or weeks to buy this position. You can't just buy 1.3 million shares of Domino's Pizza like that. You can of, the large stocks like Apple or Visa or Nvidia, of course. But Domino's Pizza, it's a mid cap stock, right?
Yep.
$15 billion market cap. So why do you think they bought the company? What do you think the next steps are? And I'll let you explain.
When Berkshire takes a position in a company, the stock usually pops.
Yeah.
Because, Buffett's buying the stock.
Yeah.
And it's like he's the greatest investor of all time.
That's right. And he tends to more often than not buy and hold.
Yeah.
And there's always a potential that he could buy the whole damn thing, right? And so get in before the getting gets really good.
And in this case, I think most observers think that it is one of his investment deputies, either Todd Combs or Ted Weschler, who made the investment because it's a small investment.
Okay.
I think those who don't really know how this works is that Buffett hired two guys to hire about 10% of the equity portfolio.
Okay.
And they have total autonomy to invest how they want to invest that portfolio.
So they don't have to run their buys and sells through.
No,
Buffett's.
they do not.
Okay. I'm sure they discuss it with him.
Yes.
Yeah.
No, and I think a lot of times when Berkshire makes a position in a new stock, if it's a smaller one, people usually say, "Oh, it wasn't Buffett buying the stock; it was
who
Todd or
cares?
Ted."
So
right?
who cares? Yeah.
And from a certain perspective, that's like it's fair to say it's 0.3% of Berkshire overall. So it doesn't really matter to Berkshire overall.
No.
But then it's on the other hand, you also can't just hand wave it away because it is still your money as a Berkshire investor.
That's right.
Like if I pick a stock that goes, that doesn't go well, Barry can't be like, "Oh, it was just all Ernest."
Yeah. No, right? No. I don't, people would be very unhappy with all of us.
Right.
Yeah. Okay. So,
but anyways, this pick was very likely Todd or Ted.
Yeah.
Because of the small size, and although we like Domino's for reasons that we've talked about many times in the podcast, I think it's a bit out of character overall for Berkshire, even from what we know about Todd and Ted, because Domino's is kind of like it's like a good company trading at like a reasonable valuation.
Yeah.
Not like I don't think it's trading at like a dirt cheap multiple, and it certainly doesn't meet the test that Todd Combs had talked about in an interview where about the criteria that he looks for, which is stocks trading below 15 times earnings with high degree of confidence that it will be a bigger company in 3 to 5 years.
Okay. So maybe this was a trading opportunity that they saw instead of a long-term hold. The stock Domino's Pizza the last few months has been beaten up.
Yep.
The results, although good, were not as good as expected. Issues with some of their international franchises, same-store sales growth not as sexy as it used to be. The lower income consumer is, you can see in the results of McDonald's or Burger King, is not spending, like they're tapped out.
Yep.
They can't afford a large pizza even at $6.99. So they're trading down, and so that's impacting the results. It's not like Domino's is hurting. The growth is still pretty good.
Yep.
But it's not as been good in the past. But maybe, like us, we're excited about the future of Domino's. We think that the results will improve going forward. The growth will reaccelerate, and Domino's will introduce more products. Maybe it will raise prices. Maybe it won't. and margins will improve, and we think they'll fix some of their issues that they're having internationally. So the thesis to us makes a lot of sense.
Yeah, there has been some speculation around that Todd and Ted have not been doing very well for Berkshire overall. Like, I think part of that is just due to tracking the performance of the picks that they've made.
Yeah.
Some of that is due to the Buffett, publicly saying that Greg Abel is the next CEO of Berkshire, and not really mentioning Todd or Ted. And I think some of the criticism is fair, but I also think that they have brought value to Berkshire in ways that people often don't talk about.
Yeah.
So, for example, it was their idea to bring Apple to Warren Buffett, right? Like, they were the ones who inspired Buffett to buy Apple, which is the greatest investment that Berkshire has ever made.
One of the greatest investments of all time. Buffett went all in. He said that if he finds a great idea, don't be surprised if he goes all in and goes crazy on the allocation. And that's exactly what he did. He wrote it from 12 or 15 times earnings all the way up to 30 times earnings. And, what do you have? A multi-bagger on the stock.
It was also Todd who brought precision cast parts to Berkshire. And I think it was Ted who did the home capital deal for Berkshire. So they are doing a lot of other things other than picking stocks for Berkshire, and have contributed to the business in ways that may not be immediately apparent.
Okay, so when one looks, of course, at the holdings of Berkshire, it kind of looks like a plate of spaghetti. You have some of the larger positions that are obviously the Warren Buffett picks. Those tend to be ones that are multi-billion-dollar holdings where he doesn't do a lot of trading. And then you have another 30 or 40 stocks below that where it's either Todd or Ted making those purchases, or maybe Buffett fooling around with some things. It's hard to know. And some people have been commenting, well, they get into a stock at one quarter and they get out. You saw with Suncor, for example, Canadian energy stock. They were in that for two quarters and out for 2 quarters, and they got back in, then they got out. You saw that last quarter. They bought Ulta Beauty, which is a retailer of beauty supply and shampoos and conditioners, all that stuff, nail polish. They were in that for 1 quarter and got out. Like, that doesn't seem characteristic of the Warren Buffett buy and hold strategy. And most of those sales seem to be, we bought it and sold it at a lower price. So any explanation that's going on there?
I actually have no idea what's going on there. But I think at the end of the day, you have to keep in mind that these portfolios are, again, very small portion of Berkshire's overall portfolio. The vast bulk of the value of Berkshire is in the large whole companies that they own, like the insurance company, like the railroad and those kinds of things. And
I mean, more importantly, this really gets to, you get calls from clients or people read in the newspaper that, well, Buffett obviously must think the market's overvalued because he sold down Apple. He's got this much cash. He must be concerned. And then, of course, the market keeps going up and people are making fun of Buffett for, haha, you missed out. You should have. I even think one guy said he should have put the cash into Bitcoin.
Yes.
Buffett's going to do what Buffett's going to do. We've talked about it before. There's no signal value for you for what you should do for your portfolio. Did you have 50% of your portfolio in Apple? Probably you didn't. So don't worry about if now Buffett only has 20% of his portfolio in Apple. You still probably don't have 20% of your portfolio in Apple anyways either. So what are you going to learn? And Buffett certainly didn't come out and tell you that stocks are overvalued or he's worried. He came out and said that he is worried about capital gains. And he sees interest rates at multi-year highs and wanted to take advantage of it. He told you exactly what he was going to do. So that's all we can learn from it. And things change. I mean, next quarter, Buffett could go crazy on the buyback, make a huge buy of something, or raise more cash. We don't know. So I think we'll just move on to Live Nation. We feel very satisfied about the stock price move in Live Nation. Ernest, we've held that through some very interesting and tough times. We held that through the pandemic, where for 2 years, pretty much there was no concerts. And now the stock is at all-time high. We held that through the company worries about antitrust regulation, and the lawsuit actually came to fruition. So even the worst case scenarios happen to Live Nation.
Yep.
And yet here it is, the stock has, delivered a fantastic return for our clients. It's at an all-time high. You got to really take those lessons in, right? It's focus on long-term, focus on the quality of business. Ernest, why is Live Nation doing so well?
Well, I think it's just their business model.
Yeah.
I think part of it is that there were worries that in 2022 and 2023, a lot of the concert demand was just revenge spend from COVID when everybody was stuck at home, and then now they can go out and party.
Yeah,
right?
Of course.
That turned out not to be true. And it turns out that people go to concerts because that's what they want to spend money on.
Yeah.
I think there was a slide in their investor deck that suggested that people would rather go to their favorite concert than have sex.
Okay. I think clearly, they're spending a lot of money on those Taylor Swift tickets. So, the cost of going to concerts, especially the ones you want, are just unbelievable, but the demand is absolutely there, right? So,
are you a Swiftie?
I only know one of her songs is a "Shake It Off" song. So, Ernest, the music I like, the music I like, the bands are so old. It's I don't even know if they're touring anymore. But
I think she had a police escort into Toronto.
Amazing. No, she deserves it. She is royalty. She's bringing in the bucks for. I mean, the Toronto should be paying her to come, right?
I thought the escort was just because the traffic was so bad.
Yeah.
But anyways.
Yeah.
So the reason why the stock is up so much this year is because I think there's two reasons. Number one is that concert demand for 2025 is extremely strong. Yeah. Ticket sales are up double digits.
Yeah, so I mean, you're going to have tours from Post Malone, from Taylor Swift's continuing, Oasis, which is a brand new one. I think Oasis hasn't toured for like 15 or 20 years. So they're selling out tours across North America and Europe. And Michael Rapino was on CNBC the other day, and he's like, there's going to be a lot more big announcements. So they feel really good about stadium tours. Stadium tour is what, 20, 30,000 plus people at a concert. So versus this year where it was a little bit lighter on stadium tours?
Yes, this year they had more shows in smaller venues, which obviously have less people.
Yeah.
But that's more of a reporting issue than anything real, actually meaningful. Next year, again, will be a very strong year. And then I think the expectation that with the election, antitrust pressures will probably, take a bit of
center stage, so to speak.
It's going to ease up a little bit.
Okay,
I think that's the expectation that the market has on why the stock has rallied.
So since the lawsuit has been announced, there's been no further information, right? There hasn't even been a trial yet. There hasn't gone to. So no, there's probably not going to be any news on that till later 2025, maybe even 2026.
Right.
What does Live Nation feel about its chances when it comes to the Department of Justice looking to break up Live Nation and Ticketmaster into two companies?
Well, we've talked about this before, but I think the merits of the case have been extremely dubious to begin with, because Live Nation has been operating under the consent decree that the Department of Justice granted in 2010.
Okay.
And if they're following the rules, you can't just go back and change the rules of the game, right? Like that's in essence what it is.
Yeah.
And then a more fundamental issue is that the things that Ticketmaster gets blamed for and Live Nation are not a result of the business practices of Live Nation. It's just the reality of the supply and demand of concert tickets, right? The reason that Taylor Swift concerts are like $1,000, $2,000. It's not because of Live Nation or the ticketing company. Yeah. It's because people want to see Taylor Swift.
For sure. And she's not she could do a show a night for 3 years and probably sell them all out. And so the stock has moved up quite significantly. I was looking, Ernest, the other day at the valuation and expectations. I don't think the stock is that expensive, even with the run up, if you consider it like we do as an amazing business model. It's trading, we think, at a pedestrian valuation compared to what other high quality businesses trade at. So I still think there's a discount on the business. We talked about this offline. Maybe it doesn't screen very well, like on PE or a price.
Margins.
Yeah, margins, but on price to free cash flow, it does.
Yep.
And also, the company is sacrificing some free cash flow today to buy up stadiums and venues, correct?
Yep.
And build their own. Yeah.
Yep. So they just held an investor day, and not surprisingly, the core of their strategy is to focus on international and to focus on building venues.
Yeah.
So for the international part, I think it's part of the same tailwind that has benefited Live Nation over the last decade, which is that today artists make as much money touring in the rest of the world as they do in the US.
Yeah.
Right. So if Coldplay goes to Australia or
Yeah.
Singapore or India, they're making as much money as they do in the US.
The ticket prices are
The ticket prices are comparable.
Okay.
And because of the globalization of music, because of Spotify and YouTube and those kinds of things, everybody knows who Coldplay is all around the world.
Amazing.
Right?
Yeah.
So that's why Live Nation is focused on building venues in these places that historically have not had big music venues.
Yeah, I read, or I can't remember if it was one of the management team that said like the growth of the live music business in emerging markets is like at the infancy.
Right.
Like there's just so much runway to have multiple, like it's really up to the energies of the artists, whether how much energy they have to go out and play this many tours, but there's so much white space to, like you said, put on a concert in Singapore or Indonesia or what have you. Yeah.
Yeah, apparently I think there was a concert where the Filipino, like the president, like, he chartered a helicopter to like fly himself in at like the people's expense.
Okay. Okay.
And people were a little bit upset about that.
Well,
But but to your point, that's what's driving Live Nation.
okay.
And it's also a little bit, I think, helpful from a regulatory perspective because if they are focusing on international expansion, like these are outside of the domain of the Department of Justice in the U.S.
And as a result of the strong price performance, Michael Rapino is going to become a very rich man. He got he's been at the helm, I think, for almost 20 years now at Live Nation, give or take, and options based on the performance of the stock, and kudos to him. He's steered the ship through some extremely difficult times, and I think he's one of the unsung heroes. I think the allocation of capital to buying their own venue, that really solves a problem that the Department of Justice wants to beat Live Nation up over. It's like, okay, we'll just own it. we'll just own the venues. Then you don't have to worry about us picking and choosing which ones. We'll own them all. So very interesting strategy that the company's taking. And you said they're pretty coy on their investor day because they don't probably want to.
So I think the overhanging question about Live Nation is their regulatory issues with the Department of Justice. I think the Trump pick, to get back into politics a little bit, to the extent that Matt Gaetz does become the Attorney General.
Okay.
I think he has, expressed that he agrees with the current regime in terms of antitrust, both for in terms of big tech and how they are, and how Lina Khan is dealing with them, as well as antitrust in general. So maybe the stock is a little bit overextended in terms of excitement about looser antitrust.
Yeah.
But generally, we like the company and its growth prospects going forward.
Super. So that's a good overview of Live Nation, and appreciate your insight there on what's happening at Berkshire Hathaway. So we'll finish off with the mailbag version. Starting, this is our brand new feature. We'll take some questions. We posed some questions on Twitter, so we thank everybody for responding, and I got some interesting ones. I think I'll read one off, Ernest, and then you can read one off, and we'll go from there. This is from Jordan Della Posta at J Della Posta. Thank you, Jordan, for following us. He's a big fan of the show, so send all your friends. So he asks, how does your firm, Ernest, deal with risk in a portfolio? Do you use options, stop losses, or just diversify as much as possible? And that's a great question. When the stock market goes down, and it will, How exposed are you guys, and what would you do to protect clients' portfolios as a result of volatility? You want to answer that one?
Well, some of the, I think this is not really necessarily maybe what he's asking,
Yeah.
but the way that we deal with volatility is through the asset allocation at Baskin. So if you are a client and you feel nervous about the markets, or maybe you need to buy a cottage or something,
Yeah.
you're going to have less stocks in your portfolio.
Yeah.
That's the primary way that we control for that.
I think we do diversify, Jordan. We own a portfolio of what we believe are high quality, good businesses that we believe will stand the test of time over multiple business cycles. That we do not use stop losses or options. Those are trading vehicles. Those are mechanical vehicles that may or may not work in lots of circumstances. They also come with costs. Stop losses could mean that we would trigger a stop loss is essentially saying I own National Bank at $135. If it trades at below $115, get me out, right? So it's protecting. It's a form of portfolio protection. But the stupid thing about it is, you could get sold out at a much lower price.
Right.
You'd have to pay possibly capital gains, and then the stock could recover. So, and then when you get back in, so it's not for us. Also, a lot of the stocks that we buy aren't covered by stop losses as well. Like you can't place stop losses on, I think, NASDAQ stocks.
Oh, really?
Maybe I'm wrong. I got to check it up. I thought there's some specific stocks you can't put stop losses on. But anyways, we don't do stop losses. We don't do options. There's lots of costs involved. I call that financial trickery. It has nothing to do with long-term investing, being business owners. And so our approach is own good businesses, ride it out, make changes where possible, and really focus on the asset allocation for the individual client's circumstances.
Yeah, I think I agree with all of that.
Yeah.
And I think the reality is that volatility is just a part of the stock market.
Of course.
And I think that you control that by owning good businesses that you want to own, not by using tools to minimize the volatility, because in my experience, like a lot of those tools end up leading to worse outcomes than if you just own the stock.
100%. We've seen it. I've been in business for 25. I've been in this business for 25 years. I've seen only damage done by using these so-called tools to minimize volatility.
Yep.
All right. You want to read the next one?
So is this from Lil Snipes 23?
Little Snipes 23.
Topicus and Lumen's long-term outlook. Can we add them to the coffee can contently? So that's the first question.
Yeah. Okay. So for people asking, what does the coffee can approach to investing mean? Do you know?
I think it just, I've never heard this term before,
Okay.
but my guess is that it's just something that you add to every month.
The coffee, well, I think that's almost right. I think the coffee can is kind of like you empty the coffee and you put money in that coffee can and you just leave it in there forever for a rainy day. So the coffee can portfolio is something you put money in and you never touch. Right. So the question is, Ernest, would you buy Topicus and Lumen and hold them forever?
Right. I think yes,
Yeah.
I would. For those who don't know what Topicus and Lumen are, they are spinoffs of Constellation Software, where in essence, Constellation used the stock of one of their what they call operating groups to merge with a company that they wanted to buy. So in the case of Topicus, they merged Topicus with TSS. And in the case of Lumen, they merged Lumen with a company called Wide Orbit. Mm-hmm. And I think the benefit of doing the spinoff, before that, these are still controlled by Constellation. Mm-hmm. Constellation still owns the board votes, and they still have majority ownership. But I think the benefit of having these spinoffs is that it becomes a more pure play on that specific vertical. And I think more importantly is that the executives and the employees in that business have a currency that allows them a little more alignment with what they're doing.
Yeah. Well, so many people would ask, Ernest, are Topicus and Lumen like baby Constellation softwares? and I know how well Constellation software is done over the long term. Would these react the same over the long term? And I think the answer probably is yes. It has Constellation DNA in it. One thing that gives me a lot of comfort, as I remember when Mark Leonard, when Lumen was spun off, Mark Leonard said in the press release that I will be holding shares of Lumen myself, and I hope that my grandchildren will also hold shares of Lumen in the future, right? So essentially saying that he plans to keep this in the family for a very long period of time. If it's good enough for Mark Leonard, probably good enough for Ernest Wong. And so this is Little Snipes 23 at Little Snipe. His name is Nico Mavrikos. And Nico also asked, he fit 2 questions in there. Sneaky guy.
Okay.
It's the other one, Ernest.
it's not the same guy?
Yeah, same guy. So he wants to know about Brookfield and its wealth solutions business. That's Brookfield's insurance arm. Yeah. How big could that get over the next 5 to 10 years? Quick summary of what Brookfield is doing there in the insurance business, and your take on the potential for it.
So the high level for Brookfield's wealth solutions business is that basically they go out and write annuities.
Yeah.
They sell them to retirees or whoever, and then they'll invest the float from the annuities into fixed income through their Oaktree business, because their Oaktree is a very skilled manager of fixed income.
Okay.
And so they earn a spread on that.
Yeah.
Right. I think this is a clear portion. It's a very material portion of Brookfield's growth going forward.
Yeah.
I don't remember the exact figure on how big they think they can get.
I think it's up to $1.5 billion of a size right now, and they're hoping that in the next few years it will get up to $5 billion.
Right.
So be almost one of the largest parts of its business, excluding the management of other people's assets.
Right.
Yeah.
And would they spin it out in 5 to 10 years?
Would they spin it out like another? Oh my God! Didn't Bruce Flatt say something kind of funny in his most recent letter about spin outs? Did you remember what he said?
No.
He said, like, we've been very successful spinning things out, but maybe too successful, and people don't want us to do any more spins. So he's kind of like Brookfield. There's like 8 different publicly traded Brookfield. So I think Bruce Flatt said we're not doing any more spins in the short term, but in the future may happen. Obviously,
I think it can happen because the way that the insurance business is structured is that there's something called Brookfield Reinsurance.
Yeah.
Brookfield Reinsurance.
Well, it's now called Brookfield Wealth Solutions.
Right.
It's
And it was a stapled. It's a little technical now, but it's basically a separate security that's tied together with the core Brookfield stock.
Yeah.
It's called a stapled unit.
Yeah.
And so if you're buying Brookfield, you get both of them,
Yeah.
but kind of not as well.
Yeah.
And I think the plan is at some point to separate it.
Yeah. So we'll see what happens. Well, maybe we'll do one more. Do you want to talk about capital allocation, Fairfax, or Pine Tree? Which one do you
Well,
know
I
better?
mean, I think this is a good question from Corey Traverse.
Yeah.
At Traverse 11.
Okay.
Okay. Says, awesome work, guys. Can you explain how you decide on a percentage allocation to one stock? If it drops and rises, do you use market value or cost as the percentage you decide what move to make next?
If it drops?
I think what he's asking is,
If it drops or rises, yeah.
like, do we modify the portfolio based on like stock moves? Like if you own 2 stocks and then one goes up and one goes down, you sell the stock one, the expensive one, and then buy the cheap one.
Yeah.
And maybe this is a cop out, but I think we run separately managed portfolios at Baskin, so there's other considerations in addition to the relative attractiveness of the stocks in the portfolio. Like there's tax considerations, there's liquidity, and those kinds of things.
Yeah.
So we generally don't do a lot of this.
No.
Beyond normal rebalancing.
I think that's the correct answer. In the bright words of Peter Lynch, we do like to let our winners run. We do use some risk management tools to not allow any one position to get up to too large a size in our portfolio, rightly or wrongly. That concerns us in terms of overweight positions. We have a fiduciary duty to our clients to protect their portfolio. And even if you're a genius and you get one stock absolutely right, it can fall, and that could be painful. So those are the tools we use. If we do trim a very large position, yeah, sometimes we will look at names in the portfolio and a client's portfolio that are smaller weight to add to them. But also we may look at a position in the portfolio on a specific client and say, well, that one's attractive because the stock price has fallen more than what we think the intrinsic value has fallen, right? So we may do a bunch of that. So the answer is, because we're, as Ernest said, because every client has a different mix and portfolio and tax situation. It really depends on the portfolio manager's decision of on the client's specific holdings and what makes sense at that time. Technically speaking, when we buy or sell something, we get rid of it for everybody. We buy it for everybody that makes sense. And we like to diversify, have 25 to 30 names, and really start out with equal weight positions. So that's the way we do things at the Baskin Wealth Management kitchen. And you may cook your portfolio differently. This is the way we're comfortable doing it. So really enjoyed the mailbag feature. We'll do more of this in the future. Hope you did too. We'll let you know when we're doing the next one and ask for your questions. If you liked our podcast, please subscribe on YouTube, Spotify, and Apple. We'd appreciate a 5-star review as well. And if you have any questions or want to reach out to a portfolio manager at Baskin Wealth, we'd love to talk to you. So we'll see you back here real soon.